is Professor of Finance and Economist, University of Ghana. Prof, we have been at this for a very long time, and thanks for the scholarship and guidance that you continue to give all of us on these issues. But look in the crystal ball and tell us, how does end of this year look like?
Good morning, Samson, and good morning to our cherished listeners and viewers. Samson, why do you want me to be the one to say what it will look like end of this year? I think it doesn't look that good. I'm hoping that it doesn't have to get worse than what it is right now, because in its present state, it's unbearable. The difficulty is that, Samson, there's practically no shield when it comes to the pass-through of the depreciation to businesses and households. The impact is almost synchronous. Elsewhere, in some jurisdictions, the pass-through of exchange rate depreciation takes some lag. But because of the overdependence on imports and the low local content in our economy, the exchange rate has almost immediate effect or impact on households and businesses. And there's practically no shield, okay? And there are no mitigating measures, right? And therefore, we are just exposed in the manner that it happens.
I don't understand that there's no shield and practically no mitigation measures or something of the sort. We were able to hold the dollar when it took a similar, flight. And we held it at 10, 11, thereabout for quite a while. So it is possible, Dr. Bawumia will say.
Yes, I do not disagree with that largely. But something, that for how long? And within those periods, you notice that part of our foreign exchange management has been going to the international capital market to take dollars from euro bonds. And then also we support that with the syndicated cocoa loan. These are the two major inflows. Then some relative fiscal discipline. But something, as we speak right now, these two major inflows are all at risk. We've lost market access. Right. So if you check, since 2007, with our first Eurobond issue, and even particularly as part of our revamped debt management strategy, inbuilt in that is going to the Eurobonds. So annually, we've been doing $2.53 billion from the Eurobond market to shore up our international reserves. And we also get a syndicated cocoa loan. But from the third quarter of 2021, we lost market access. Okay. Then also look at the other major inflows. Cocoa. Ghana is doing poorly now with cocoa production. Okay, so all of this put together actually putting some kind of our undermining confidence in the economy. And you see that also manifesting the negative sentiment that we see. But beyond that, something, part of why the Cedi is behaving the way it is also consistent with the latest IMF-supported program. Under the IMF-supported program, they favor flexible exchange rates, which in itself limits the ability of the central bank to intervene in the market and fight off the depreciation, okay, by burning it through our reserves. Now, at the time we signed up onto the IMF-supported program, in fact, December 2022, our international reserves on net basis had reached a precarious state. In fact, it was less than 3 weeks of import cover. Okay, so part of the IMF program is to build our international reserves to the level of 3 months of import cover by 2026. What that means is that it ties the hands of the central bank from coming onto the market to sell dollar, okay, on its own account in order to mitigate or moderate the depreciation. They can't do that now. They can't do that now. Okay, so if we're not under an IMF program, probably in an election year, the central bank will not sit unconcerned and probably would want to fight it off and burn it through the reserves. But we have a mandate target within the IMF supported program to build our reserves. And bear in mind also the reserves that Bank of Ghana had a cocktail celebration over, right? It's so simply because we are not servicing our external debt, right? Coupons and the rest of them. So why are we in this situation? Others have spoken about the structural issues, the conjunctural issues, and the rest of them. But there are other current developments fueling this negative sentiment. Part of that is also the delay with the restructuring of our external debt. By now, we were hoping that Ghana would have passed the second review, which would have occasioned the release of the third tranche under the IMF-supported program. But because the country has not been able to secure the MOU, which is a condition precedent to IMF board approving the second review, there's that delay. And then again, the uncertainty with the external debt restructuring. So that vacuum, the market is reading a deeper meaning into that. And that is why you see the negative sentiment has gone up. And the understanding in the market is that negative news actually exert greater volatility in the market compared to positive news of the same magnitude. Somewhere April, the Ministry of Finance attempted to preempt this by coming out and telling the market that they had reached agreement with our external bilateral creditors. That was supposed to calm the market. Once you reach that, then it shouldn't take us that long for the IMF board to approve the second tranche, out of which we may get $360 million. Usually, if that had happened and we had a board approval, that positive news would have probably engineered some confidence in the economy. Okay, now we are missing out on that. The other bit we also need to bear in mind, something, is that it's an election year. Usually, election year comes with its own uncertainties, right? Okay, so we have all this happening together with an election year that promises to be a competitive one. When it happens that way, in terms of portfolio flows into the country, there's a slowdown, right? So foreign investors would usually adopt the attitude of wait and see, right? Lest the election, before they commit to any major investment or portfolio flows to the country. Apart from that, the residents, you and I, businesses, because of that uncertainty, they are likely not to take major decisions. They may not trade their FX. They will rather prefer to store the value, yes, as a way of managing the uncertainty. Now, so if you put all these things together, so once we are not trading our dollars, look, assuming we had confidence in this economy and people are willing to trade their dollars, even the bedroom economy, and we're able to mainstream that into the mainstream economy, you will see some relative stability. But right now, there's no confidence in the economy. Everybody is trying to protect their value. So once you are, for instance, if you have 1 million Ghana cedis right now, there are very limited opportunities, options available to you, and you don't want to keep it idle. Then your basic instinct will be preservation. Then you'll be looking at a currency that is more stable, and the cedi is not stable. Okay, so people are cashing it from that perspective. The other bit, from a more technical point of view, is that the foreign exchange market, we can segregate it into two components. The spot market, where if you need a dollar immediately or over 2 business days, you will go to the spot market. If you need a dollar in 3 months' time, in 6 months' time, you don't need to be in the spot market. You have to operate in the forward market. But our forward market is not working. Okay, it's so shallow. So even for people who need dollars in 3 months' time, in 6 months' time, are actively in the spot market, accumulating the dollars right now. And so what it means is that we're actually fast forwarding the pressure of 3 months to today. And when it happens that way, there's no way the cedi will be able to hold its own against the major trading currencies. Now, seriously, let's come home. In this country, we are okay to do everything wrong and expect the cedi alone to do the right thing. The cedi is the pulse of the economy.
All right.
The cedi is the pulse of the economy. So it doesn't misbehave on its own.
All right.
Right. So it's a reflection of some underlying weaknesses that we need to resolve, which we haven't done. And here we can even talk about the fundamentals of the economy. Look, something. We said it on this program. When we got the IMF program approved, actually yesterday was exactly 1 year. the 17th IMF-supported program was approved on May 17th. That immediately delivered what we call the IMF honeymoon effect, some relative stability. And then we took credit for it and celebrated prematurely. We said, no, it is not a substitute for doing the right thing on the ground.
That's right.
And we haven't done that.
Okay.
We haven't done that. Then we suddenly expect that the Cedi will perform a magic and the rest of it. Doesn't happen that way. And
Prof,
look, we can go back to what Dr. Baumia said when he was in opposition.
Right.
If the fundamentals are weak, the exchange rate will
expose you.
Right. And let's ask whether the fundamentals have improved significantly. The answer is no.
Doc, thank you very much as always, Professor Bokpin.